Hey, what's up everyone? Welcome back to the channel where we cut through the fluff to bring you practical, no-nonsense tips. Today, we're diving into Tesla, one of the most talked about stocks in the market. We're going to estimate its intrinsic value using the discounted cash flow (FDF) method with a Google Sheet I built just for this. If you haven't seen my previous video on how to use this Google Sheet for valuations, make sure to check it out. I'll leave a link in the description below. It's a great step-by-step guide on setting up your own DCF model so you can apply this method to any stock. So stick around, I'll be sharing my thoughts on how Elon Musk's potential involvement in a new US government agency could impact Tesla's stock price. So let's get into it. Alright, if you're new here or need a quick refresher, the discounted cash flow method is one of the most widely used techniques to estimate a company's intrinsic value. Let's work on this together. Stick around to the end because I'll tell you what price to pay for Tesla share. Now that we understand the DCF method, let's dive into the numbers. I've already set up this Google Sheet with Tesla's key financial inputs, and we're going to run 3 different growth rate scenarios to see how they affect Tesla's intrinsic value. The idea here is to account for varying levels of optimism around Tesla's future growth. First, let's look at a conservative case with a 10% annual growth rate over the next 5 years. This might reflect slower expansion or tougher competition in the EV market. Now, the terminal growth rate is set at 8%, which assumes Tesla will eventually stabilize and grow at a slower but steady pace after these high growth years. Let's run through 3 scenarios using different growth rates for the next 5 years: 10%, 20%, and 30%, which will give us a range of possible intrinsic values. With a 10% growth rate, Tesla's intrinsic value comes out to $80.71 per share, and this is the lower end of our range. Now, let's move to a moderate scenario with a 20% annual growth rate. This is a reasonable rate where Tesla has proven on its own past record. At a 20% growth rate, the intrinsic value jumps to $123.08 per share. Finally, let's check out the optimistic scenario with a 30% growth rate, which assumes Tesla will continue its explosive growth. Tesla's intrinsic value would be $181.91 per share. I would think this is a very bullish scenario for Tesla as it continues the explosive growth and market expansion. These 3 scenarios give us a good range of possible outcomes for Tesla's intrinsic value. On the low end, we see a value of $80.71 with just 10% growth. But with more optimistic projections, Tesla could be worth up to $181.91 per share if it maintains that 30% growth rate. It's important to note that these are intrinsic value estimations based on the DCF model. Speaking of growth rates, let's talk about what analysts are forecasting. Right now, the consensus is that Tesla will have a pretty high growth rate, somewhere between 20 and 30% annually over the next 5 years. It's clear that even with 30% growth rate, the market price for Tesla's share now is significantly higher than the $182 projected with the DCF model. But here's the key takeaway. DCF is just one of the many methods to evaluate a stock's intrinsic value. While it's powerful for breaking down future cash flows, stock analysis should always include qualitative factors as well. This means looking beyond the numbers and diving into things like the company's management team, its competitive advantages or moat, brand reputation, and long-term strategic vision. For example, Tesla's brand is incredibly strong, and Elon Musk's leadership has been a huge factor in its success. These kinds of qualitative insights are crucial, because they can impact Tesla's future performance in ways that the numbers alone might not capture. I've made a separate video that covers these qualitative factors in depth, so check out the link in the description below if you want a deeper dive into analyzing Tesla's brand, management team, and its competitive position in the electric vehicle market. Now, this brings us to an interesting point. There's been a lot of buzz recently about Elon Musk potentially getting involved with a new US government agency. If that happens, it could give Tesla a significant advantage in terms of government contracts, regulations, and even strategic influence. And if investors are factoring in Musk's influence, that could explain why Tesla's stock price is inflated beyond the intrinsic value we calculated. Here's my take. After running the numbers using my Google Sheet, I found that for Tesla to be worth its current price in the market today, the company would need to grow at a 45% annual rate over the next 5 years, with an 8% terminal growth rate. That's a pretty steep growth assumption, especially considering the average estimated growth rate from analysts is around 30%. Clearly, this suggests that Tesla's current price isn't just based on its core business fundamentals, but also factors in other elements, what I like to call the Musk effect. This refers to the premium investors are willing to pay due to Elon Musk's reputation, innovation, and now, the increasing likelihood of his involvement in U.S. government initiatives over the next 4 years. So while Tesla remains an exciting investment opportunity, it's important to recognize that today's price has definitely priced in more than just Tesla's expected growth. The stock is also reflecting Musk's influence, potential political involvement, and the broader belief in his ability to disrupt industries beyond EVs. And that's a wrap. If you found this breakdown helpful, hit that like button and subscribe for more deep dives like this. Also, feel free to download my Google Sheet template from the description below to run your own DCF valuations. Let me know in the comments, what do you think about TSLA stock, or what stock you'd like to see analyzed next, and I'll see you in the next video. Until then, stay financially savvy.